All right, in today's video, we are going to go through a small but very important detail when it comes to Guardian whole life insurance policies, which is PUA rider fees. So when it comes to PUAs, that PUA rider paid up additions, what's the goal or what's the purpose of that rider? It's what maximizes the cash value, short-term, long-term, especially when we look at the guaranteed values. However, Guardian, specifically with their L95 policy, now has two PUA riders available. And the difference between the two PUA riders is specifically the fee that is assessed to the PUA payment. So when we look at the different fees that are available, we have two of them. We've got, and this is only with the L95 policy, a PUA fee that's at 5%, and then a PUA fee that is at 10%. When it comes to Guardian, all other whole life insurance products as of the date of shooting this video, we're in November of 2022, they all have a 10% PUA fee. Now, a quick side note, Guardian for a long time had a 5% PUA fee across the board for all whole life insurance products when the guaranteed rate was 4%. As a result of an industry update, the 7702 update, which went into full effect in 2022, what Guardian had done was updated their PUA rider fee to 10%, which was across the board on all whole life insurance products. However, they did receive a lot of feedback. I love Guardian because you always have access to some of the higher ups there, so I was able to speak with them as well, which I really appreciated. And just in speaking with them, providing feedback from consumers, people taking out policies, there was still a lot of interest in that lower PUA fee. So what Guardian did is they wanted to keep the 10% PUA fee, but specific to the L95 policy, which is a product that can deliver very strong early cash value if you do things right, what they had decided to do was keep the 10% PUA fee, but offer the 5% PUA fee as an option. Now, when it comes to the PUA rider fee, when you are starting your whole life insurance policy, whichever option you select when starting the policy, not when submitting the application. So if you're starting the underwriting process or if you're in underwriting, I can apply for A or B, but then decide to take a different one after the fact. But it's once you start the policy, whatever option you choose, you're locked in for life, with the exception of the 120-day change period, which means up to 120 days after you start a policy, you can make changes, meaning we can change the death benefit, add different riders and such. We can make adjustments within that 120-day window, which is pretty cool. But after that, I'm locked in forever. So we're going to take a look at these two PUA rider fees. This way, if you're looking at options and trying to determine which one's best for you, this video is meant to help with exactly that. So let's get on into it and have some fun. What we'll start with here is we've got a 45-year-old male. This is the case, the actual case study we're going to look at when we review numbers. And we're going to look at $100,000 per year going into a policy. And we'll look at a clean 1090 split. So we'll have a 10% base premium. You'll have approximately $1,000 that's allocated toward the term rider. It's approximately $1,000 in the first year, and then it'll gradually decline after year one, the cost that is, and then about $89K directed toward PUAs. So a policy that is set up to maximize the cash value. And what we'll look at here, as far as funding scenarios, are as follows. We've got a 5-pay, this individual paying in $100K per year for 5 years, and then B, $100K per year for 10 years, where with the Guardian policy, we've got to design it a little bit differently for each of these scenarios, A and B. If I want to go with option B, what you'll find is I need a higher death benefit, specifically more term insurance, in order to, one, raise the MEC limit, but two, add enough term so I can continue to 10x the base premium in PUA payments specific to a Guardian policy. So the design will be slightly different, mainly through the term insurance rider. And then what we'll look at here, this would be a fun one with option C, is $500,000 in the first year only, and then you will see $100K per year thereafter. In theory, we could do $500K in only year one, but this is Guardian's 50X rule, where in the first year, we can actually pay 50X the base premium in PUAs. So we'll keep the base premium the same and just plow a ton of money into an initial dump in, and that'll look pretty good, especially when we analyze both the 5% and the 10% PUA fee. Now, what's very important to look at here is both the non-guaranteed values and then also the guaranteed values. So again, guaranteed values and non-guaranteed values. Guaranteed rate is 3%, which is assessed to the guaranteed values. And then I've got the non-guaranteed values, which assumes the dividend interest rate of 5.65%. So let's continue on here. PUA fee. So PUA fee at 5%, we see STP here. On the illustration, when we pull that up, that you'll see this terminology, STP. Guardian is referring to this as a short-term performance rider enhancement. You'll see exactly why. And then if you don't see STP there, just a basic PUA, then that results in, or that means you have the 10% PUA fee. So let's look at the differences here. Number one, we've got first year cash value. This is with the 5% PUA fee, 86 to 88%. What that means is if this is you on the left, this 45-year-old individual, you pay $100,000 in the first year, you're going to see between $86,000 and $88,000 in cash value. So the first year is very cash rich. It looks a lot like that old Guardian product, meaning before the 7702 update, the 4% guaranteed rate and the 5% PUA fee. Great for strong first year cash values and an early break-even point. Before we hit on the break-even though, let's look at the 10% PUA fee. So the first year cash value will typically range somewhere between 81 and 84%. Usually right around that 82 to 83% range. But there is a difference in the first year cash value. Where people often look at this is one says, okay, if I'm paying in 100 grand total and it's set up with a minimum base premium, here I might see $87,000, whereas over here I might see $82,000. It's a $5,000 difference, but then at the same time, I'm giving the company $100,000, and one I see 87, it's only a $13,000 hit, as opposed to a $17,000 hit, getting close to 80%. That's where I just look at it and say, that's hard for some people to actually go forward with that. That's a big reason why Guardian made this 5% PUA fee available again. The break-even point, between 3 to 5 years with the 5% PUA fee. Looking at the 10% PUA fee, the break-even point will typically fall between 4 to 6 years. The non-guaranteed values, when I compare them side by side, and we're going to look at numbers side by side, you will see with the lower PUA fee, you will have more money on a non-guaranteed basis, based on the present dividend rate, for the first 10 years. Typically, it's the first 10 years. Whereas with the 10% PUA fee, we'll have less the first 10 years, but from the 11th year onward, we will see more value. So the cash value and death benefit, for that matter, will be stronger long-term based on the non-guaranteed values, based on the present dividend rate when we look at that illustration. Analyzing the guaranteed values, what you'll see, lower PUA fee will result in stronger guaranteed values start to finish, no matter what. Unless I mess up the illustration and run something like a 5% PUA fee, keeping the term rider forever, or not going reduced paid up and then trying to favor the 10% PUA fee unless I do something intentionally wrong or forget to click a couple buttons on the software. If all things are truly apples to apples, you will see stronger guaranteed values from start to finish with that 5% PUA fee. So the guaranteed values over here, never higher with the higher PUA fee. So to summarize these bullet points, a lot of people look at it, including myself, is what the lower PUA fee gives you is more money guaranteed and more money up front. Whereas the higher PUA fee, the 10% PUA fee, gives you more potential, particularly on the non-guaranteed side of an illustration, based on what the company can do with the money via dividends. It's interesting to be aware of that. Or it's good to be aware of that, I should say. So what I want to hit on here is a couple questions that people often ask, including myself, and how business owners and real estate investors often approach this. And we've got that word underlined there, opportunity cost. So anytime we're taking out a whole life insurance policy, if cash value is your goal, if you've got a laser focus on maximizing the cash value because you want to use the policy, what I want to look at, or what I want to ask myself is, what is the intention of taking out this policy? Do I want to maximize the value based on the guarantees upfront for an opportunity cost, or do I want to pay money in there and have as much as I can possibly see long term? Could be both. But as you compare the different options, just Always go back and say, okay, what's the purpose to taking out this policy, and how do I maximize the cash value from start to finish, and then begin to use the policy. Whenever we're looking to use the policy, if you maximize the value first, that puts you in the best overall position. So when analyzing the 5% and 10% PUA fee, here's the biggest question that comes up. Because when you look at the 10% PUA fee on the non-guaranteed side, you will see more cash value, and it is noticeable. However, one will ask this, taking into consideration the guaranteed values and more over here, is can I do more with the money? So the money I have in cash value, can I do with more money up front than the extra 50 basis points, 0.5%, that I might receive with a higher PUA fee? And some people will ask themselves this question when they are looking at a higher base premium, because we can make an illustration look better long term if I go with a higher base premium and take less upfront. But the question is, am I comfortable potentially getting more money long term with having to give more upfront? So for example, if you give $100,000 and you can have an option with $88,000 upfront, it's guaranteed, it's there, you can use it for whatever you want, or an option where you've got $84,000 upfront and you might have more long term, which one would you pick? Well, if you just want to park it, let it sit and grow, this one might be a little bit more appealing, might not be. But if you view it as, hey, I'm taking this out because I like the guarantees and what I can do with the money, investing it in my business, investing it in my real estate, like that's where I'm really going to make the money. And I'm viewing the whole life insurance product as an area to park the money in the meantime, instead of having funds in cash or wherever I have it positioned. So that's always a good question that people ask, or we like to ask for them. Just it depends on the purpose of the whole life insurance product, but it does help when trying to choose the right PUA fee, because the advantage to Guardian is they're one of the major mutual companies. We've got proof of performance from them. They deliver, and their PUA rider is extremely flexible. A guy or girl who says, hey, I want the ability to pay in $100,000 per year. They want this type of design, but they only want to commit to the minimum with this design right here. They're committed to approximately $11,000 per year, and then at discretion, they can add the other $89,000, 100% whenever they want. So you can make Guardian policies extremely flexible while maintaining the quality. The question is then, how do I want to use it? And do I want more upfront and more long-term guaranteed, or do I want less upfront with more long-term potential? Another question, do I need to access all of the extra cash value in the first 10 years? So I'll ask this question or a similar question with Mass Mutual's high early cash value product, as that will produce more value upfront in the early years. So as I compare the difference between the product that gives me more upfront and the more long-term, take the 5% PUA fee example. If we look at the non-guarantees, you will have more with the 5% PUA fee in the first 10 years. So the difference, the additional money you have years 1 through 10, when you see that and think, okay, I want access to that because I know I will access it, or 2, it just gives me peace of mind, going back to the opportunity cost, because I know what I can do with it, like I like having that there. I'm more comfortable with that. Then I would gravitate toward the 5% PUA option. This is just how I would view it. If you looked at it and said, you know what, the difference is $10,000, $15,000, I don't know if I'm going to access the additional 10 or 15K. I'll take the long-term option. That could be the way you approach it as well. We're going to look at things side by side. So do I need to access all of the money in the policy and then compare the two side by side to help make the decision there? Help you make the decision? And then here, do I like stronger guaranteed values? Which is kind of a, I don't want to say a trick question or trap question. The answer is always yes, beef up the guarantees. And here's how I also look at it. Do you plan to use the cash value? And remember, if you do, when do you want to use it? How do you want to use it? How much do you want access to? Always maximize the cash value first. Because if that cash value is maximized, what that does is it puts you in a position where you've got maximum value from start to finish, where that just gives you more money to use more than anything else when it comes to borrowing against the policy, repaying, using it like a personal line of credit, if that's the intent. So let's take a look at scenario A here, and then in the next video, we'll compare that, or we'll also look at scenarios B and C. So in scenario A here, let's take a look. What we've got on the left are the dividend values. So this is a side-by-side comparison. Before actually we analyze the dividend values, let's make sure everything is a fair comparison, because that's the most important thing when we're comparing the same product but just two different PUA riders or two different variations of that product. So what we've got here is the 5% PUA fee, and you'll actually see on page 3 in this particular illustration, it'll usually be page 2 or 3. You'll see the term here, paid up additions rider. And you'll see this terminology, PUA, STP. Then here the terminology, or the different bullet points we've got here. Last bullet point, a 5% charge will be deducted from each payment. Now, that can sound scary, especially when it's 10%, but what I'll add is anytime you see a PUA charge or any expenses, call it a term rider cost, anything that's associated with the policy, the net cash value or total cash value, the terminology is used interchangeably with different companies, but net cash value, your money column on an illustration, that's the net value after all expenses, everything are taken out of the policy. Then after the company credits all dividends and interest and everything, that's the net value at the end of the day. The net cash value column, that is, which looks like this, second to last column. What do we see here? Net cash value, which does account for the 5% PUA fee. So here's what I want to hit on, because we're going to look at these numbers on the Excel sheet when we've got everything side by side, but base premium, $10,000. That gets you a whole life death benefit of $423,000. Term rider, 1376. Add the two together, net death benefit, $1.8 million. And we cut the term rider after the first 7 years in this example. That's why we have the death benefit drop. PUA rider, here we go. Cost of the term rider, which the PUA payment first covers, and then everything else goes into PUAs, $592.44. One thing I would take note of on this illustration, and it's how we can identify it's a 5% PUA fee, is this right here, STP, which represents short-term performance. Now, we also have the guaranteed values here, and you can see that under an additional report to the left, where we've got guarantees. This shows the guaranteed value. So 500 total in, 100K per year for 5 years. Year 6, just about breaking even. Year 7, positive. And this is based on Guardian's guaranteed rate of 3%. So this is the 5% PUA fee. Let's go back to that ledger statement. See everything here? 10K base, whole life death benefit, term life death benefit, PUA payment, term rider cost. Let's go to the 10% PUA fee. What do you notice here? Base premium, whole life death benefit, term rider amount, net death benefit. What's slightly different in terms of numbers here? Before looking at the net cash value, everything above this red line. Remember what the term rider cost was in the other example? The 5% PUA fee example? $592 and change. Here it's $598. Let's go back just to see it. $592 with the 5% PUA fee, $598 here with the 10% PUA fee. Term rider amount's the same, so why does the term cost a little bit more with the higher PUA fee? Small difference here, but why is that? The reason why is because if you have a higher PUA fee, less money is actually deposited into that paid up additions rider. And when funds are deposited into the paid up additions rider, we always think cash value, but it also purchases you paid up additional whole life insurance. And with this term rider, as your whole life death benefit goes up, your term rider goes down over here. So because slightly more money is taken in fees, what that results in is slightly less money added to our whole life death benefit, which requires the term to be slightly higher, and that's why that term dollar amount is a little bit higher. Small dollar amount, right? But it's a detail that sometimes people look at that, I would, and say, hey, why is that different? That's why. All right. So here's our net cash value. First year, 82,857. Remember what it was in the last example? It's 87 and change. If we go back, there we go, 87,447. We can get that above 88 too with a couple of minor tweaks to this illustration. But here, you're at 82 and change. Break-even point, back to the 10% PUA fee. How you can tell, there's no STP here, just PUA. Break-even is year 5. If we go back to the short-term performance, what do we have? Break-even, year 4, between years 3 and 4, really. Same thing, or similar when we look at the guarantees. Well, not quite, actually. So back to the 10% PUA fee, guarantees. The other one was just about year 6, remember? You're at 498 in year 6. Here you're at 472 in year 6. Between years 8 and 9 is when you break even, based on the guarantees, with the 10% PUA fee. Would you like to see a side-by-side on Excel so we don't have to keep going back and forth with illustrations? Let's do that. So here we go. Dividend values first, then we'll compare the guarantees. So on the left, 5% PUA fee. On the right, 10% PUA fee. First year cash value, 87.5 almost, 87,447. Versus over here, close to 83. There's a difference, several $1,000s. What's highlighted in yellow represents the break-even point, meaning your cash value is equal to or greater than what you've paid in. So year 4, you've paid in 400, cash value is 403 and change. Whereas over here at the higher PUA fee, it's a clean year 5. Paid in 500, you've got 500, almost 501. Now, first we'll just eyeball it. What I mean when I say that is if I look at year 6, because he's 50 years old in this case, which one has more money? All right, it's noticeable that the 5% PUA fee does. How about year 10? 5% PUA fee, but not by much. You're about $1,000 ahead. And then by the time you hit year 11, which one has more? 10% PUA fee. And as time passes, if you want to look at year 25, it does become more drastic, or much more noticeable, I should say. So now you're close to $100,000, 90 to be precise. And we can look at a cash value difference column, but let's look at the guarantees first, shall we? So when we look at the difference here, what do we notice now? Guaranteed values. Oh, so close there by year 6. That's with a 5% PUA fee. And then with a 10% PUA fee, it's between years 8 and 9. Now, a quick way to determine which one has more cash value long term is when looking at the guarantees. If you're not adding PUAs to the policy, the guaranteed values will assume no dividends are paid to the policy, so the death benefit will not increase. The only way that you'll see the death benefit increase based on the guaranteed values is if you run an illustration where you're actually adding funds to PUAs, or if you have a policy where you're adding funds to PUAs. Here, we're not adding anything. We've gone reduced paid up, and if we were paying just the base premium, we would not see the guaranteed death benefit increase either. Where I'm going with this, talking about the death benefit, is when we hit age 100, you'll see that cash value match the death benefit there, the guaranteed death benefit. So a quick way to determine which one gives me more money is by looking at the guaranteed death benefit. Say, okay, the 5% PUA fee has about 60 grand more in death benefit there. So I know by the time I'm 100, I'll have $60,000 more in cash value based on the guarantees. Now, while all that is cool to talk about, let's look at some numbers here. And what we'll do is just look at a quick cash value difference column. CV difference. Here we go. And let's subtract the 10% PUA fee from the 5% PUA fee. And here we go. This is a total of 500 grand. It's always going to be relative based on your actual situation and how much you're funding a policy with. We had a couple people recently that were looking at $500,000 per year going into a policy. $500,000 per year, not a total of $500,000. And just with the differences there, when we looked at the guarantees compared to non-guarantees, the guaranteed values, we had several $100,000 more with the lower PUA fee. And just looking at that, they really ended up, or one of them at least, gravitated toward the lower PUA fee. The other one is still reviewing everything at the time of shooting this video. So there's my non-guaranteed values. There we go. This is how much less I have with the 10% PUA fee for the first 10 years. And then if the dividend rate remains constant and the insurance company does what they think they can do, there's what I'll have as time passes, how much more I'll have with the higher PUA fee. Interesting, right? Let's look at the guarantees though. And this is where I need to analyze it heavier and make a decision, because it is up to us. And you can diversify. Maybe you're looking, this person, let's say he's looking at 100K per year, and instead of picking one or the other, he says, you know, I like the upfront cash value, I like the stronger guarantees, but I do like that long-term potential a little bit. So what's it look like if I take out one policy where I pay in 70K per year and 30K per year in the other, and both are the same ratios, 10/90 split, 10% premium and everything. It's all identical from a ratio standpoint. You could do that. Maybe it's 50-50. It's ultimately up to you. Purpose of this video is, again, to show different options so you can choose the one you're most comfortable with. Personally, I do tend to gravitate toward the stronger guarantees just because a lot of the historical policies that we study, what I've noticed is the illustration with the strongest guarantees a lot of times ends up delivering the strongest actual performance. I'm always digging into that, but I have noticed that as time passes. And I like that 5% PUA fee because all of the historical policies we've studied, including ones we've placed with Guardian, had that 5% PUA fee. So it's just something that, hey, I can count on it more. Not to say the 10% PUA fee won't deliver, because it's a quality company and I have a policy with that 10% PUA fee, which I will be tracking over the years. This way we can actually provide real proof of performance instead of just illustrations. But again, information here is the main point. So I hope that this video was helpful from an information standpoint. In the next video, we're going to look at options A, B, and C, mainly B and C with the longer funding period and then the large lump sum. That'll be a lot of fun. But if you enjoyed this video, please hit the like button, subscribe for more. If you have any questions, feel free to leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.